Can I invite our moderator for this panel, Dinesh Giridhar, who is the MD and CEO of Dolat Capital Asset Managers? Dinesh. I found this very interesting quote about that Dinesh made, that his emphasis is on blending human oversight with systematic methods, which I think, please Dinesh, is incredibly critical as the industry progresses. Next up, Prashant Bisht, Deputy CIO and Fund Manager for True Beacon. Where are you, Prashant? Thank you so much. Prashant shares that to deliver superior risk-adjusted returns, the team must implement a robust investment process that scans multiple quantitative and fundamental factors. There's so much to unpack within just that statement. And can I invite Nishant Bansal as well, please? Nishant is a fund manager who previously worked with Tata Asset Management. Nishant says that the need to traverse asset classes forms the core of his investment philosophy. And I think that becomes very fascinating, especially where every asset class has its own unique personality. Last, can I invite Rohit Jha, co-founder of ArthAlpha. Where are we, Rohit? Rohit has done some very interesting work as well, advocating a principled approach. I like this quote, Rohit. Innovation and discipline are the cornerstones of success. How funny that none of these are quant, but really human qualities. But on that note, over to you, Dinesh.
Thank you, Joel, for the lovely introductions. Hi, everyone. Good morning. I really hope our session is going to be as engaging as the previous ones. We are here to talk about the challenges of running a long-short quant strategy, our live experiences. And our panel is been through the thick of things with regards to the quant universe. So we'll jump straight to it. We have about 30 minutes. We have a lot of ground to cover. I've prepared a set of questions which I think are most relevant in today's context. So I'm going to get right at it. So considering India's position as an emerging market, where a large share of fresh liquidity continues to flow into long-only strategies, primarily driven by the perceived alpha potential. And then there are these structural constraints around shorting in India, like limited F&O coverage and SLBM access. This is the context. I have two parts to this question. Do long-short quant strategies risk swimming against the tide of dominant market behavior and investor preference? And two, how do you account for this inherent long bias in the markets in your alpha models and portfolio construction? We can probably start with Rohit.
Check. I think if you look at recent years, the demand for long short has indeed gone up, but it's also about how the market perceives risk. I think investor awareness is a big part, and when people look at returns, often they do not look at risk-adjusted returns. And this has also been due to absence of a lot of diversified strategies available to the investors in general over the last decade. But if you look at last few years, especially last 1 year, the demand for long short is also going up, and quant strategies as well, because the markets have been turbulent and people are looking for more consistent returns. So I don't know if this is going to continue in the long term, but it does seem like this is giving birth to a set of new fund houses coming up who are focusing and tapping on this, catering to new set of strategies that could take up over the next decade or so.
Yeah, so I think from our perspective, and I think referring to the question here, we have seen a lot of growth coming into the long-only strategies, and I think the bigger backdrop around this money coming in is largely because of two reasons. One is Indian investors actually have gone from being savers to investors, and at the same time, what we've seen is that they have been invested largely in physical assets, and post demonetization, post COVID, things have been more financial in nature, and very naturally, some of the instruments, some of the asset classes which have been through thick and thin have been time tested, which is actually long only equities, has commanded the largest market share. Having said that, obviously long short is a unique asset class, as I would call it. Brings a very diversified or a very differentiated set of risk reward attached to it. And the key to understand and swimming against the tide or for the tide is actually the correlation with the traditional asset classes that long short strategies bring to the table. So as Rohit also mentioned, there's obviously like very increased need for investor education around how these long short strategies or long short funds would actually fit investors' portfolio. As they're increasing their wealth, how much of the the corpus can actually go towards these strategies, and what are the expectations they should have from these strategies. Talking about the second part of the question was around how we as practitioners think about strategies. How do we, since so much money is going into long only, how does it impact our performance and our thought process around the long short side of things? So one of the ways quantitatively we have started thinking is that most of the people will care about net risk of the strategy. I think internally we have developed a beta adjusted metric for the net delta, and that kind of factors in how much growth or how much size risk that we have in the strategies, and we look at a beta adjusted number, which is the net beta adjusted number, and depending on our view on the markets, we typically would either hedge it or just run with it. But we are aware that there's like a big amount of flow that is coming in, which is increasing the beta of all these strategies. And second is on the correlation side of things. Obviously, having saying that this is a long short strategy, so the correlation with traditional asset classes has to be low. I think we want to demonstrate that when the markets are turbulent, and when I say markets, equity markets are turbulent, we are able to actually generate that performance or protect capital. So we would typically always have some tail hedges on the book, which will protect the portfolio when it comes to the downside risk. And that's how we typically think about these things.
Excellent. Prashant, your take?
Great. First of all, good to be on this panel. Thanks to Rishi and Pankaj. So let me make three statements about this question. Okay. First is, I think long short, if you split it into just the core market neutral signal, will always be relevant, and allocation in terms of resources to that will keep increasing. Second statement, long short as a product will always face a challenge whether in India or outside India, given how the underlying market is doing. And third statement is that as the ratio of wealth to income in India changes, right, being able to have uncorrelated returns, risk-adjusted returns, alpha, will become much more important, right? And hence, I think the wallet share is going to increase. So let me just unpack this a bit more, right? So if you look at just any portfolio, you can always, using simple linear algebra, break it into exposure to market and a set of market neutral weights, right, which will sum to 0. The key point being that you can use an alpha generation signal, which is market neutral, on its own as an independent strategy, if it is strong enough, or also as part of your long only exposure to create alpha, right? And I think given the fact that we have gotten more tools, which will obviously help us pass data, more data which is accessible digitally, I think that trend will not change. What might happen is that if markets are really bullish, people might just start incorporating that same information in a different product, right? So I think that's a product thing. Coming to my second part, second statement that I made, right? So if you look at post 2009, what has happened is that US and India correlations have jumped dramatically, right? They have actually doubled in that period. So if you look at post 2009, post COVID, actually the outperformance of Indian markets is not on its own, right? So this is, so it's like, I think post COVID is like a 20% return. The key point being that investor interest will wax and wane how the underlying markets perform, right? But I think there will always be some category of investors for which this will make sense. And like I mentioned, right, I think what happens is as your wealth becomes much more higher as proportion to your income, 1-2% alpha risk-adjusted returns, right? They create a significant impact on what your overall net worth is, right? And I think that basically means that a lot of people will start actively thinking about this problem because it's becoming more relevant.
Right. That's great. I mean, this was to set the context and set the premise for, the general structure of the market. Let's talk about some universal strategies, and each of these, the treatment of each of these is different I'm sure when we've discussed offline from all of y'all. I'm keen to know how you treat these strategies. So let's address the first, which is trend following. Trend following strategies on the long side have historically delivered great results in the Indian markets, possibly supported by structural growth and retail investor momentum. Given the market's inherent upward bias, which we discussed, and the relatively shallow participation on the short side, how viable is trend following as a strategy for short trades? So let's start now with Nishant.
Yeah, thanks for the question. So when we think about trend following and in general making money from the short side of things, I think just from experience, and obviously like all of us have been in the markets for some time, you see markets correct, and then there is obviously a very sharp recovery post that. And the timing of exiting the shorts actually becomes very, very crucial. And an extension of that obviously is the holding period of, in general, the shorts, which we have on the book. So traditionally, if I have a trend following strategy which gives me a short signal, then the backtest itself will actually correct for what is the holding period, so that I optimize for the risk and reward I'm actually looking for. But from relatively speaking, from a success point of view, what we have seen is that the shorter holding periods of time have statistically given better returns on a much smaller time frame. So I'll talk about, for example, intraday. When we think about shorting intraday, the tail of how the stocks which are performing negatively is actually very, very fat, which tells you that if a stock is actually trading at, say, 2 sigma on a day, there have been much more instances of it trading at actually like 4 sigma, 5 sigma in that sense, which creates those opportunities for actually like shorting at that point of time, which is counterintuitive. And that's where I think the quantitative element of things will actually clarify a lot of things, that the data is showing that intraday when things start trading at 2 sigma, they'll likely also trade at 3 or 4 as well, and that's an opportunity for you. But when you start extrapolating that to bigger time horizons, these things just disappear. And our algorithms are designed in a way that they will actually like start holding these things on a much smaller time scale. And at the same time, our positioning size is also very small, because we have to come out of that position at very quick time frames as well. So that's how we think about entering from the short side.
Fantastic. Rohit, you want to take this one next?
Yes. So if we look at trend following in long short, right? So as we were discussing, there are broadly 2 approaches to long short that we take when we say we investors in this market. One is the approach where you are looking at relative betting, where you are looking for, let's say you have say Google and Apple. All you want to figure out is Google going to do better than Apple or the other way around? You do not care if the market as a whole is going to go up or down. It does not matter to you. As long as you do it right, you are going to make money, right? Go long on one, short on another. The other approach is where you care about making money on both longs and short. So you absolutely care, okay, the ones I'm going to go long on, am I going to make money on that? And my shorts, am I going to make money on that? When you talk about the latter, then the holding period, horizon, and do factors work on the short side becomes very important. Even trend, right? Then you need to be very careful at what horizon that trend is actually going to work. Because on long side, you can take the beta, you can take the drift and make money on average in the long term. But in our approach, that problem goes away because we are looking on a relative basis. So even when we are looking at relative trend, all we are looking for is the stocks that have stronger upward trend, the stocks that have a strong downward trend. And that is also on a relative basis. What I mean by that is adjusted to index, adjusted to common risk factors, so that when you look at idiosyncratic risk of a stock, then you are able to observe it better and take a decision which stocks I want to go long on and which stocks I want to go short on. And in this case, horizon also becomes slightly not redundant, but less important, because you can run it at different horizons and still make consistent alpha. So to summarize, for us, shorting is not about making absolute money on it, but it's again about making alpha over the index. So on the stocks that you have shorted, are you making on average return over the index? If you are doing that, then we are doing a great job on shorts, irrespective of whether the market is going up or down.
Prashant, your take?
Quickly, like I mentioned, I think any portfolio can be constructed as just an exposure to market and market neutral portfolio. And I think at least I have seen more success in incorporating trend signals within that long short bucket rather than the beta exposure. So I think has been a slightly harder problem for us. So once you flip the statement to just saying exposure versus, let's say, a pure market neutral portfolio, then the trend question becomes lesser relevant as long as you have crossed those factors.
Interesting. Let's talk about the contrarian, which is mean reversion. So from what I've seen, mean reversion strategies, particularly at high frequencies, primarily are the domain of HFT firms. Considering the short-lived nature of the market and market downturns and the potential need for shorter holding periods on the short side, does the technological infrastructure required to operate at those speeds become a significant entry barrier for implementing effective long-short strategies? Prashant, you want to start with this one?
Yes. So again, I think I'll keep guiding back to the same thing, right? If you look at the problem statement as exposure to market and long-short portfolio, then the key question is just figuring out that long-short portfolio. And I think if you look at any research, everyone is trying to normalize all kinds of variables to reach a mean reversion, stationarity, weak, strong kind of transformation, right? So that I think is the way, at least I think about this problem. Separately, I think technology is relevant whether you are an HFT or not. In HFT, you have to be, let's say, in the top 1% to make any money. But that need not be the target of, let's say, any long-short fund. With so much of data coming in, particularly when you start thinking about impact of international markets, whether you want to trade across asset classes, maybe trade globally, building a great technology infrastructure, not just for speed, even in top quartile, let's say, is good enough, but also a platform that helps you make faster decisions and more accurate decisions is something that simply you need to invest. And that is where most of the leading global hedge funds which we aspire to are there in terms of technology. So I think that's table stakes.
So Rohit, if speed is of the essence, how are you going to overcome this?
So adding to Prashant's point, right? So one of the characteristics of a mean reversion strategy is you can't hide behind beta, which you can do in a trend following strategy to a great extent, right? But that being said, in the end, you can always construct mean reversion strategies at different horizons, even at intraday, even at daily level, even at month level. Challenges vary. Stock selection, how you enforce successionality or weaker version of it, that varies. So if practitioners are looking to enforce it at daily and longer horizons, they can do it with no need for extraordinary infrastructure. But if they're looking to do it at a shorter horizon, even if minutes, then infrastructure becomes very important, and often it is the difference between you making money on the same thing that I'm building or not. So yes, it is very important, but it depends at what horizon you are operating, and especially as you go to longer horizon, where also you will be able to extract alpha from this strategy, and so their infrastructure is not that important.
Nishant, your take?
Yeah, I think broadly consistent with what the both of them mentioned. I think we operate in a world where you have to choose between what returns you're generating and what scale you are going to generate them. And I think as scale becomes more important, I think that's when you start transitioning from the speed game to actual analytical game. So speed starts mattering less and less, and I think the power of data essentially, which we'll talk about maybe, and also like how good you are in terms of your signal generation becomes a lot more important. And I think at that point of time, it's largely around how much is the holding period that you have for that mean reverting strategy. What is the edge that you actually bring to the table? Is that unique data sets? Is that unique way of understanding of the markets? And that will actually define your edge in those things. Yeah.
Right. Now we should address the differences in the strategies deployed globally and locally here. What types of long, short, quant and systematic strategies that are currently prevalent in India, what are the long short strategies that are currently prevalent in India, and which ones are currently missing out but popular globally and can help investors in India also in the long run? In that context, what statistics or quant methodologies do you use to decide which of these strategies can be combined together to achieve your risk return objectives? And how do you statistically decide when to remove strategies and when to add strategies from the entire combination of your strategies? Nishant, you want to take this one first?
Yeah. So when we are comparing the Indian ecosystem versus the globe, I think I usually talk about a very simple way of understanding, which is imagine a table, which is essentially the surface area of what the market opportunity is. The breadth of the table essentially is talking about how many tickers or how many instruments that you can actually trade on, which obviously, as we realize, at least in the derivative space, is close to 225 in India, versus more than 1,000 actually like available just on the US exchanges. So the breadth obviously is different. The depth, again, we can talk about depth in multiple ways, top of the book liquidity, like level 1, level 2 as well. And in general, how much liquidity is there behind those orders as well. We have seen anecdotally as well as practically as well that when you execute large set of orders, it's very difficult to actually like execute them with low amount of slippage. So the depth is actually very limited, except for the first, like I would say, 10 tickers in India. And last is actually the height of the table, which is also very, very important because that differentiates the whole strategy scope. When I say height, you can think of it as how many expiries can I trade around to. For example, some of the strategies which are primarily driven around the Vega play on options are virtually just impossible in India because you cannot express a long Vega opinion because the theta bleed is too high. So in general, I think the market structure is such which prohibits a lot of strategies which are very prevalent and generate like good amount of alpha across the world, but not in India. In addition to that, again, another challenge which we face as practitioners is, around the stocks in ban. How much open interest you can actually carry. When the size becomes big, you'll obviously see that some stocks actually start going into ban. And, our risk management engines have to be smart enough to actually flag us that, okay, like you're getting bigger into this, ticker, so just don't build too much of a size. And then obviously liquidity around some of the strikes will also start disappearing. And there's complexity around taxes as well when it comes to coming out of these strategies. So yeah, in general, I think we've seen far less scope of doing what globally is possible. Having said that, I think India's ecosystem is like actually growing. SEBI introduced 44 new tickers, new stocks, which are now part of FNO, and they're growing in volume. So there is definitely a lot of scope to actually generate the kind of strategies which we talked about. I think mean reverting, trend following, even like the security selection strategies actually tend to work pretty well in India. So I think that's what my thoughts are around this. Yeah.
Prashant, your take?
At least I think about this slightly differently, right? I think if there is a way to make money, we'll figure out a way to make money. I think it is much more a question about how easy regulatorily and liquidity-wise whether is an instrument. Right. So obviously before 2002 there were no derivatives. In front of me, I've seen people learn derivatives, make arbitrage, then HFT. So I think if you look at set of strategies, I think it's much more dependent on what instruments are easily available for people to trade. Otherwise, more or less, at least my view is that people are using similar kinds of strategies, statistical arbitrage, merger arbitrage, HFT, trend following. It's just that the level of sophistication based on data and models might be different, and obviously liquidity is an issue.
Excellent. Rohit, you had an interesting take on this.
Yeah. So the way I think about it is this. I'll give an example. Let's say you have good food in front of you, right? Would you take the effort to go to the next town to go into a restaurant which will serve a similar food or maybe slightly better food and have it? Most probably no, right? Because it's too much effort, and why would you do it? The only challenge with that is when you run out of that food, right? You would eventually have to go. And if you are not prepared for that, you'll be in a lot of trouble because you might die hungry, or it might take you a few days to arrange for a vehicle and then go there. So when you look at global and Indian market, global markets have become way more efficient. Let's talk more especially US market. They are way more efficient. And the quant firms, long shot firms, strata firms, they have been there for decades. When I say decades, we are talking 50 years, right? Which in India is less than 10 years. So they have been through that evolution, they have evolved, and the kind of strategies, the depth of strategies has evolved over time. Even the kind of data they use and the amount they spend to build those strategies. That's not true in India, reasonably so, right? So if you look in India, the kind of strategies prevalent would be, we just talked about trend, we talked about mean reversion, some others are factor, most people here, we talk about factor rotation, that would include value growth, and a few others, analyst rating recommendation. Some might go to the extent of using news and sentiment. I think that is where it ends for 99.99% of the practitioners. And that is where the opportunity set lies. While they are able to manage with this because market is not very efficient, there's not a lot of players, but this alpha is going to erode. We saw recently in Jan, momentum crashed, index rebalance strategies crashed, and some people saw the worst drawdown they have seen ever in last 5, 6, or I think 10 years in long short strategies. The way to fix that would have been to diversify well, to have enough kind of strategies. So right now we said momentum and mean reversion, right? But when we see, and when we say when global counterparts, we see it as a class of price action. And there we have 50 plus categories, not just 2, right? Even in momentum, we have 10 plus momentum. Most of them, I would not even say momentum. They are momentum, but not in the traditional definition, right? So when you have that kind of diversity and depth, so we will be there. I'm hopeful we'll be there, but it's going to be a journey. As investors go through these cycles where they do realize the need for sophistication, need for diversification, need for better, if not better, but uncorrelated strategy. They'll go and look for it. It's there. It's not that it's not there. It's just a need has not arisen for most people, and that is why it's lacking right now. Should I cover the second part of it?
Sure.
Yes. Sure. So we're also talking about, how do you evaluate what to keep, what not to keep, right? So the first part is very easy. So how to decide what strategies to include. So for us, it's if something is very strong, a very high sharp signal, we are talking, let's say pre-cost only. It's very easy to keep, right? Because it's a consistent signal. But on the other hand, one thing we do differently than a lot of people is looking at weak signals which are highly uncorrelated. While if you're looking at every signal at a 2 sharp, or 0.2 sharp might look too small or noisy. But sometimes if you have confidence that there is a causal relationship, it's just too weak because of the breadth you have, right? Maximum 200 stocks. And the lack of correlation, diversification it brings. When you check and add it to your portfolio, it will increase the portfolio performance drastically. And that's something that has worked really well for us because we have captured a lot of relations which are very weak. Maybe over years they will become more profound, but today they are very weak and very uncorrelated. And they add drastic values to our portfolio. So even in Jan, we did not see any drawdown. Sure, it was paper only, but we barely saw any drawdown because of this. So that's an important part. When we talk about removing strategy, what's not working, I think everyone wants an answer to that. A magic box that can tell you, okay, this has stopped working. Huh?
No, I said magic pill. Go ahead.
Yes, only if one could say that, this has stopped working, take this out. But that's a very difficult problem inherently. Often when people say, this is my backtest results, in outer sample, this is the result. This is doing better or worse. That itself is a wrong metric because you might be exposed to certain factors which have done better or worse recently. So that is how you should be looking at it. You can't just objectively say that your strategy is not doing better than your backtest or doing worse. So what matters is looking at individual signals, maybe trying to identify regimes. When I see regime, it's not macro regimes, but it's more strategy subjective regimes that you can build. We have built in-house for our signals. We use deep learning and HMM to identify them. And then we see how that has worked historically, in which regimes that signal did better, in which regimes it did not. Now, if it is a regime which it has not done better and it's still not doing good, I'm okay with it. But if it is a regime where it has done extraordinarily well, but has stopped working, then there are two cases. Either I have overfitted or the signal stopped working. The second case is the market has become so efficient that I should just put it out of the signal. So that is something people should be very careful about. And I believe over the next 3 to 5 years, this is a challenge most people are going to face. Because as we discussed, right, relatively simpler strategies today. So as alpha starts to go away, a lot of them stop working, right? The need to switch and move to more sophisticated signals and strategy is just going to go up.
Excellent. I think we're keeping time, but I'm going to just ask one more question, although I can see the timer going at a countdown speed.
I just noticed the counter.
And I just noticed the counter myself. So let's come to risk management. I have to ask this question because this is a central premise. Let's come to risk management, which is even more important in long-short strategies than for long-only strategies, given the non-linearity of risk-return profile of some of these strategies. What are the specific risk metrics and tools and methodologies that you use for different strategies, and how do you control and monitor the risks at the overall portfolio level where you have combined these various strategies? And now you can hear the beep, so I think we should try to give a very crisp and concise answer for this one.
Yeah, I'll quickly start. So I think for risk management, I think in the Indian context, it has to be a little different from the way people look at it, like from a textbook sense. You have to adjust for liquidity because, again, if you're trading a strike which becomes illiquid, you have to adjust your model around that. You have to reprice your book in a traditional sense, just to look at if a 5 sigma event happens, how much money are you going to make or lose, and to prevent that from the January kind of carnage that happened in the markets. So risk management takes center stage, and I think that's like the first thing which we do after we generate a signal. How much risk do we want to allocate, and in a bad case scenario, how much quickly do we want to cut the risk? So I'll keep it very quick.
Sure. Prashant?
So actually the way I think about risk is like a healthy lifestyle, right? It is more important to stick to something rather than what exactly you do, at least from an average case scenario. So I think based on my experience, what I've found that if you're looking at shorter term horizons, like a day, couple of days, if you have sufficient data to say what are the operational bounds of a strategy which has been systematically back tested, what are the return expectation, again based on back testing, and you've got some simulation framework which is not tied, which is like a non-parametric framework, that will in most of the scenarios work, right? Again, it's like a healthy lifestyle. On average case, you'll always be better, right? Irrespective of what you do, as long as you do it.
Excellent. I'm being nudged by Joel to open the floor to questions. So Rohit, you didn't get to answer this one, but maybe you can answer some of the questions from the audience. Can we have a mic there to the audience?
So I have two questions for all of you. So the number one question is, how do you measure, or let's say, what is the average holding period of the short book? What is the Sharpe of the short book? And what is the performance contribution of the short book in your portfolios?
So exactly. So it depends on the type of strategy. In our case, as we said, we look at alpha. So even if I talk about this performance of a short and long side, I'll talk it relative to the index or the benchmark. So in that case, in our strategies, on average, the contribution to long and short side is pretty much similar. It's 55-45, keeps shifting. Across signals, it varies. Some signals are way prominent on longer side, others are on shorter side, but at strategy level, it's 55-45. And yeah.
I think we have time for one more question. So
Can I go on for another question?
there's just one more question from that side. Go ahead.
So if I were to traditionally construct a long-short kind of a strategy basis on factors like traditional pharma fringe factors, SMB5, HML, investment, gross profitability, but doing that in India on the 200 odd triggers that we have, would I be able to capture the pure factor exposure of going long-short by restricting the universe from, let's say, 3,000 odd triggers to 200 FNO universe that I have, is the question.
Let's combine that with this question, and maybe Prashant and Prashant can just quickly.
Hi, so I'm Shashank. I'm working as a derivative analyst. My question is for Nishant. You work with Tata. So Tata has an amazing track record for managing their long-short portfolio, and in fact, it has been performing well from last 3 years now. So I have a question: how do you manage VAR for long-short portfolio?
How do we manage, sorry, what?
VAR, value at risk.
VAR, okay. So I'll answer both the questions together. I think from a factor perspective, it is actually about how you define the factor in the first place. There are some global, BARA and like other models which will actually fit on some of the stocks and create a cleaner version of how you would get exposure to one of the factors in general. I think the bigger concern, obviously, as you probably alluded to, was the liquidity and the size at which you want to put on, and that's where the the restrictions might start to come in. At the same time, just largely focus on, when you build a factor-based strategies, what is the investor behavior you're trying to capture, and are you in that, right period in which, if at all factor switching is something which, your strategy is actually like, trying to monetize on, is the way to go. So it's largely around, how the backtest performs, and what is the definition of the factor itself? How do you actually like formalize that? On your question around VAR, so when we look at our, so in our fund, and we can obviously take this offline as well, but in our fund, we typically reprice our book every couple of hours, and look at how much money we can make or lose in a 2 sigma event. And that helps us like get a good sense around what is going to be the correlation in terms of, if other part of the book, which is not long short, which is some stable beta, how that would perform. And if in a bullish scenario, if our beta performs, how much of the tail hedges are going to actually lose us money. And that's where we are able to kind of like, manage the risk around things. We don't typically look at VAR in a historical scenario, because I think the assumptions around actually calculating VAR probably don't hold true in India. So we look at like really repricing the book every couple of hours. Yeah.